Well, shares in Credit Suisse plunged to a record low, falling 24%.
Credit Suisse has lost trust, confidence from the market.
Massive indeed. Credit Suisse shares down fractionally this morning. They've been down about 20% over the last month amid a slew of announcements this morning.
For more than a century and a half, Credit Suisse was one of the most powerful names in global banking. Founded in 1856, it financed railways, helped build Switzerland's reputation as a financial safe haven, and managed the fortunes of the world's wealthy elite. But in March 2023, this 167-year-old institution finally collapsed. After years of scandals, risky bets, and massive client withdrawals, Credit Suisse was on the edge of bankruptcy. How did one of the world's most respected banks implode almost overnight? Let's break down the rise, the scandals, and the dramatic final days of Credit Suisse. The story begins in 1856, when Swiss politician Alfred Escher founded the Schweizerische Kreditanstalt, later known as Credit Suisse. Its mission has been to finance the expansion of Switzerland's railroads. From the start, it positioned itself at the center of progress, fueling infrastructure, energy, and later international trade. As Switzerland grew wealthy, so did its banks. Credit Suisse expanded into wealth management, investment banking, and international finance. By the late 20th century, it was a global player, managing billions for the ultra-rich and advising governments and corporations. At its peak, Credit Suisse wasn't just a bank, it was a symbol of Swiss stability and discretion. For wealthy clients worldwide, a Credit Suisse account meant safety, privacy, and prestige. By the 2000s, the bank was a top-tier player on Wall Street, competing with Goldman Sachs, Morgan Stanley, and Deutsche Bank. It had weathered wars, recessions, and the 2008 financial crisis, but behind the polished image, cracks were forming. But after the 2008 financial crisis, while other banks strengthened controls and became more cautious, Credit Suisse continued to push the limits. Over time, it formed a reputation for chasing profits. Small lapses in oversight and risk management gradually accumulated, and more scandals came to light. Regulators repeatedly warned the bank about weak internal controls and risky behavior, yet the culture of prioritizing profits and client relationships over proper checks persisted. In 2014, the bank faced a $2.6 billion penalty for helping wealthy Americans hide money offshore to avoid taxes, known as the tax evasion scandal. Then, in 2019, came the so-called spy scandal. Credit Suisse executives had hired private detectives to follow some former employees, worried they might steal clients or reveal secrets. The revelations forced its French CEO, Tidjane Thiam, to resign. There were also money laundering cases and corruption links, including the infamous Mozambique Tuna bonds scandal, where Credit Suisse helped the country raise billions for fishing projects, but much of the money was secretly stolen or misused by officials and hidden through the bank's accounts. All of these events weren't accidents. They reflected a culture that valued profit and relationships more than proper risk management. The turning point came in the early 2020s. Credit Suisse made two catastrophic bets. The first was Greensill Capital, a supply chain finance company. Credit Suisse packaged Greensill's loans into investment funds and sold them to clients as safe, short-term products. But in 2021, Greensill collapsed. Credit Suisse had to freeze $10 billion of client money. The second was Archegos Capital Management, a family office. Credit Suisse lent Archegos enormous sums to fuel highly leveraged stock bets. When Archegos imploded in March 2021, the bank lost $5.5 billion in a matter of weeks. These twin disasters exposed the bank's broken risk culture. Insiders later revealed that risk managers had raised alarms about Archegos months before the collapse, but leadership pressed on, worried about losing business to competitors. A fatal decision. Let's pause for a moment. If there's one lesson from the Credit Suisse collapse, it's that knowledge and control matter. That's where the Alchemist comes in. It's a smart trading tool that monitors markets and investments on autopilot. You don't need to watch charts or push buttons. The software finds opportunities and makes the trades for you. It's not about blind trust. It's about transparency and staying in control. Click the link in the description and use code Credit Suisse for 10% off. Now back to the fall of Credit Suisse.
Credit Suisse has lost trust, confidence from the market.
Massive indeed. Credit Suisse shares down fractionally this morning. They've been down about 20% over the last month amid a slew of announcements this morning. The big number is $4.7 billion. That's the charge the firm expects to take from the forced unwinding of Archegos Capital Management.
Stocks Europe 600 then being dragged down by the financial services sector, by the banking sector, down by 2.75%.
The regulator has lost patience with the bank and wants to find a buyer. What ensued was deal-making at breakneck speed, when UBS, under duress, finally makes an offer on Sunday morning.
By 2022, Credit Suisse was trapped in continuous crises. Leadership kept changing, investors were nervous, and clients quietly started pulling their money out. By March 2023, the collapse of the U.S. Silicon Valley Bank and Signature Bank triggered global panic. Suddenly, everyone was worried. Which bank would be next? Credit Suisse became an obvious concern. Its scandals were still fresh, its stock price was low, and clients were anxious. When its biggest investor, the Saudi National Bank, stopped providing funding, panic turned into a rush to withdraw deposits. In just a few days, Credit Suisse lost over 100 billion francs in deposits, and its share price hit record lows. Swiss regulators feared a total collapse, and over a dramatic weekend, the government arranged a historic forced takeover. Credit Suisse's longtime rival, UBS, the Union Bank of Switzerland, was pressured to step in and agreed to buy Credit Suisse for just 3 billion Swiss francs, about $3.3 billion, a tiny fraction of what the bank had once been worth. To make the deal happen, the Swiss government promised to cover some of Credit Suisse's future losses, while the Swiss National Bank provided over 100 billion francs in emergency loans to UBS to stabilize the system. Credit Suisse's story is a cautionary tale about business culture. It shows how a 167-year-old institution, with all its prestige and resources, can destroy itself through arrogance, greed, and poor judgment. For Switzerland, it reshaped the financial landscape. One of its two global banking giants vanished overnight, leaving UBS as the country's sole titan. Regulators are now tightening rules, determined to ensure nothing like this ever happens again. Globally, it's a reminder that in banking, reputation is everything. A whisper of doubt can trigger billions in withdrawals, and no balance sheet can survive that.